All right, hello and welcome everybody. Thank you so much for joining today, and I really hope this time today is going to be well worth your time, especially if you're somebody who's looking to plan for taxes in retirement. I want to introduce myself first of all. My name is Jason Hamilton. I'm the founder of this group. I'm the founder of Keep It Simple Financial Planning. I'm also a certified financial planner and a chartered retirement planning counselor. So I've been working in the retirement planning space for over 7 years at this point, and what I found is the least understood and the most impactful subject that most people need to be thinking about is their tax planning. So for those of you that are a little newer here, that haven't come to our workshops before, I want to welcome you. And what my goal is for this group, Your Retirement Coach, to be the number one place for you to come, ask questions, get answers, and get education around retirement. So that's what we're here for today, is to really help you get control of this thing called retirement, because it's much different than the accumulation phase, right? There's a lot of different things to worry about. And in all honesty, what you probably want to do is just relax, enjoy your life, and not have to worry about all this financial stuff. Unfortunately, there's a lot of things that if you get them right, it can really be beneficial for you. One, it can help you save money on things like taxes, like we talked about. But number two is you can help your money last longer. And I think that's a big concern for a lot of people, is that they're going to run out of money at some point. So if you get this stuff right, you get these planning items right around your retirement, there's a really good chance your money can last longer, not only for you, but if you have heirs that you want to leave money behind too, that they can also hopefully receive a bigger inheritance. I know that's probably not your main goal. I speak to very few people that tell me their main goal is to leave behind a big inheritance. Most of them are those first generation, what we call the millionaires next door, where they saved diligently and they planned diligently for 20, 30, or 40 years through their working career. And now they're at a place where it's like, okay, it's time for you to shift from earning income from your labor to earning income from your capital, right? And that would be from your savings and other assets. So before we dive into our presentation, let's warm up with a little tax brain teaser about Bill, okay? So hopefully this sounds fun to you. So after working hard for his adult life, Bill, who is 65, has finally retired, and he's going to more concerts than ever before. Bill has $46,138 in taxable income, which includes $37,500 of Social Security benefits this year. As you can see, Bill's $46,138 of taxable income puts him in the 22% tax bracket, because it's more than $726 and less than $95,375. All right, so you can see Bill here, $46,138, so he's above $44,726, but below $95,375. Okay, so he's in this 22% tax bracket, and if you weren't aware, our tax brackets in the United States are what we call progressive tax brackets, which means as you earn more, you pay more taxes. Okay? Toward the end of the year, Bill decides to take out $1,000 from his IRA for a trip to go see Willie Nelson play in Austin. How much is he taxed on that extra $1,000? So the logical answer is, for every dollar of IRA money he pulls out, he pays 22 cents in federal income taxes. Therefore, if he took out $1,000, he should owe about $220 in federal income tax, 22% tax. Simple enough, right? Well, unfortunately, that is not the case. He actually owes $407 in tax, which is a 40.7% tax rate on that income. So thanks to the madness that is our tax code and unique formula that determines how your Social Security benefits are taxed, the real answer is that Bill owes $407 on that extra income. So this is why we're doing this workshop today, because there's some rules here that I want you to be aware of. And if you can make better decisions around how you're distributing your income in retirement, you can potentially save a lot of money in taxes. So welcome to our presentation, How Tax Planning Changes Through 4 Stages of Retirement. My name is Jason Hamilton. As I mentioned, I'm a certified financial planner professional and a chartered retirement planning counselor and the founder of Keep It Simple Financial Planning. So I want to thank you for joining us to learn more about taxes and retirement. And I want to assure you of one thing about this presentation. I believe that you'll be better informed about the challenges of retirement tax planning after listening to this talk. Now, you may be wondering, why is a financial professional giving a presentation about retirement tax planning? Well, I can tell you this. After working as a financial advisor specializing in retirement planning for over 7 years at this point, I've seen just how impactful proper tax planning can be for retirees and also the longevity of their assets. Also, from time to time, I present workshops on classes and classes on various financial education topics such as Social Security, retirement planning, IRA planning, healthcare planning, cybersecurity, and late-stage college planning. My goal is always to inform and educate my audience so you can understand how critical financial planning topics affect you and your family. I do this presentation because I've seen many people make mistakes and pay more in taxes than retirement that's necessary. When that happens, it makes my job harder because then people have less income in retirement, and then we have to find ways to make their portfolios last. Also, we offer tax planning services for our clients, especially our clients in retirement, so we understand the value of helping our clients save taxes in retirement. Taxes can seem complex and jargon-filled, even though the underlying concepts are relatively straightforward. So let me take a second to explain how this workshop will unfold. All right, so one thing I do want to remind you of is that every tax situation is different, and you should always consult a qualified tax advisor to discuss your specific situation, especially about these topics. So when we are looking at different types of accounts for retirement, there are a few here and a few different situations that may impact you. The first one is a traditional IRA, and that would be what's called a tax-deferred account. So with a traditional IRA, you must pay taxes on the distributions or conversions at your ordinary federal and state rates. Roth IRAs, they were not deductible when you put money in, but now that the money's in there, the money grew tax-free, but your earnings in retirement can be withdrawn tax-free accordance with the IRS rules. So you got to make sure you follow the rules there. And in this presentation, we do mostly focus on federal taxes, but you may still face state taxes, so make sure you check with your financial or tax professional on that. And I have to make sure that I let you know that I'm a certified financial planner and I do not provide tax filing advice, but we do offer tax planning services to help you optimize your retirement income planning. So what I do is help people understand how the tax code and other rules could impact their financial planning and investments, and then we develop a plan to take into account many of the odd things people encounter, especially around taxes in retirement. So our goal here is to help you understand the retirement distribution game. Spending assets in retirement is much different than the accumulation game when you're saving for retirement. So chances are you've been in the accumulation phase for several decades at this point, and you've been working very hard trying to save your money, and hopefully the accounts you have been investing in have grown. But now, as you enter or prepare for retirement, you're in an entirely different phase, what we call the distribution phase. And the distribution phase has new, strange rules that can catch people off guard. And along with those new rules, there is often many changes in your own personal life that can have a big impact on your taxes as well. For instance, your children are grown, and that means no more child tax credits. Your house may be fully paid off, and that means no more mortgage interest deduction. If you've already retired, you may no longer be receiving tax-free employer-paid medical insurance. And if you stop working, you may no longer have the ability to stash income in a 401k or other similar plan to manage your annual tax bill. At some point, you will start taking Social Security, and sooner or later, when you reach age 72, 73, or 75, you're going to have to start taking required distributions from your retirement accounts. The list of changes goes on. Many aspects of retirement will affect your tax bill in totally different ways from your working years. So understanding what these are and how they can impact you is absolutely critical. So that brings us to a simple statement about the problem we're here to discuss. Simply put, people often pay more in taxes in retirement than expected because a confusing system treats the various income types differently and contains hidden taxes and penalties. In the accumulation phase, people build their assets in several different forms: stocks, bonds, real estates, pensions, 401ks, IRAs, and more. In the distribution phase, your regular wages stop coming in. You have to take money you've saved and use it to fund your retirement, which can go on for decades with good health on your side. That's challenging because you'll need to make informed decisions about the tax implications of tapping different accounts, and it can be costly. In retirement, your tax rate can vary dramatically based on the decisions you made, such as the timing and order which you use different sources of money to pay for your expenses. Poor choices through misunderstandings or ignorance of the rules can result in people paying more taxes than necessary, and I don't think anybody wants to pay more taxes than necessary. As a result, they may see their savings drop faster, and that can mean less to leave to the kids or the grandkids. Of course, we don't want that to be you, and the fact that you're here today means to me that you're willing to work towards a solution, which is a very important first step. All right, because your tax exposure will change throughout the 4 stages of retirement, you'll need a strategy that anticipates both traditional taxes and possible taxes, surcharges, penalties related to Social Security, Medicare, and other income sources. This means you'll need an informed and proactive plan that addresses how you create your income in retirement. So my goal is to introduce you to the major aspects of such a strategy and show you the challenges we all face, and then explain what makes up a workable solution to our retirement tax problem. The first step is to develop an understanding of the types of taxes that you may face. What do I mean by taxes? I'm talking about the cost that can increase as your income does, including some that aren't actually called a tax. To me, if your cost goes up as income rises, it's a tax in my book. You also need to understand the retirement expenses that you'll face, and you'll need to create a strategy that will help you decide which of your assets to tap first, how much you should be taking from those assets, and when those distributions should occur. Getting this right will help you pay as low a tax rate as possible. Here are the 4 stages of retirement we'll discuss. These are rough ranges and descriptions, and your experience may differ. This is just a framework for discussing our topic today. First, there's what we call pre-retirement, the final work and save years, generally ages 50 to 60. Next, the early years of retirement, age 60 to 70, what we call the go-go years, where people often have grand plans for vacation at that time. So generally between age 60 and 70, most people are doing most of their traveling, they're volunteering, they're starting new hobbies, they're working part-time many times, and they're spending a lot more time with family. Next, you reach what we call the middle years, age 70 to 80, or also what we call the slow-go years, which in those years, it's going to bring more financial decisions, such as how to deal with required minimum distributions from your IRAs and other accounts. And finally, there's the later years of retirement when your health may not be as good and you're thinking about your legacy and estate, what we call the no-go years, which is generally around age 80 plus. There's going to be, and there is, a lot of advancements coming in healthcare. So for those of you that think you're just going to pass away in your mid-70s or even your early 80s, you may be surprised that you will have healthcare that will help you live a lot longer. So we really need to be thinking about age 95 or later, maybe even age 100 and 105 when we're planning for retirement if your health is generally good now. So as you will see, there are a wide range of issues that must be planned for in each phase, and this can be a lot harder than it seems because, retirement is full of surprises, and even the best planning will divert from reality at some point. The real truth is we can do our best to make a plan for you, to have a plan that makes sense for you, but in reality, it's never going to follow exactly what we put into place. But it's better to have a plan than no plan, right? It's better to have a map and a compass than no map and no compass. So one future unknown is inflation. And for those of you that have been experiencing this recently in the last few years, and especially for those of you in retirement that may be on a fixed income, inflation has been mind-blowing. I mean, it really is destroying people's budgets. My personal food is up almost 40%. I mean, it's a really big difference than what we were paying just a few years ago. And we don't buy much different, by the way. So people tend to view their future costs in current dollars and don't always anticipate how those costs grow with inflation. So think back 30 years ago to the cost of a gallon of milk or a gallon of gas, or even a visit to the emergency room. Now think about those costs today and then what they'll grow to over the next 30 years when you're not working. That's inflation. Or how about your longevity? Many people end up living far longer than they expected, and that requires more money at a time when it's difficult to work. So the question for you is, how long do you think that you'll live? The average man is living about 85 years old now. The average woman is living about 87 years old. If those are the averages, and I should say, you might see these statistics that say, from the average age of life is 76 years old. That includes infant mortality, okay? So if you're already in your 60s, then your average is more likely to be 85 or 87, and what that means is 50% of people live longer, okay? And it's a nearly 50% chance that if you're married, one of the spouses will live to 91 or longer. So we really need to be thinking about that longevity aspect. Many people also underestimate how much money they need to maintain a pre-retirement standard of living. And who wants to see their standard of living drop? And then there are healthcare costs, the 10,000-pound gorilla. That includes your out-of-pocket payments for services and drugs, plus Medicare and insurance costs, which keep rising. Okay, so don't forget, you will need to pay for Medicare out of your Social Security check. That is something that's going to bring down your check less than you might have thought. Now, at this point, you may be thinking, okay, so what's the first thing you need to understand about retirement and taxes? Well, here it is, our first key. You have to know your after-tax retirement savings picture and what that looks like before you actually retire, okay? Because a $500,000 401k or IRA isn't really $500,000. The government has a claim on part of that money because the taxes were deferred. they'll get a share of that money when you're forced to start your required minimum distributions. The RMD age was 72 last year, but the recent Secure Act 2.0 has pushed back RMDs to 73 if you're born between 1951 and 1959. If you were born in 1960 or later, you will not have to start taking RMDs until you turn 75. Obviously, the higher your tax rate in retirement, the less your account is worth. So here's an example. This chart shows you the cumulative after-tax amounts you can expect to receive from a $500,000 IRA earning 6% per year at various tax rates. And as you can see, the lower your rate, the more money you'll keep. Simple in theory, difficult in practice. And by the way, of course, this presentation applies to both pre-retirees and retirees, so don't worry if you've already started your retirement. Tax planning is important throughout your retirement. But let's take a look here. If you look at what your account could turn into over the ages, you can see that depending on your tax rate, it can be much, much different, right? So if your tax rate is, 0%, then you might end up with a little bit more money after tax. If your tax rate is 12%, then obviously it's going to go down. And if it's 33%, then it's going to take another, hit from there. So these are all things to be thinking about when it comes to what your after-tax retirement income is going to be. And this is where we need an individual solution. So you may be thinking, okay, my accounts are not worth as much as I thought, but I'll have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay your taxes. But one thing you need to understand when creating your retirement tax strategy is that Social Security and Medicare have their own tax traps that you need to plan for as well. So let's talk a little bit about Social Security and taxes. Let's go back to Bill from our tax brain tease. We want to understand why he paid such a high tax rate on the extra money he took from an IRA to go on a concert road trip. So remember, Bill has $38,000 of IRA income, part of his adjusted gross income of $61,838, and he has $37,500 of Social Security benefits. That puts him squarely in the 22% tax bracket, and he takes the standard deduction. Yet, when he took that extra $1,000 IRA distribution, he got hit with nearly a 41% marginal tax rate, which was $407 on that $1,000. So let's break this down on how this actually happens. First, remember, the only difference between our two scenarios here is that Bill has taken an additional $1,000 from an IRA. So you see that in the after concert trip column, he has on the $39,000 of IRA income. So we see here that by adding that additional $1,000 of income, it increased both his AGI and his taxable income by $1,850. That means for every dollar of income he actually received, he's being taxed on $1.85. So how does that work? So here's the deal. Depending on how much other income you have, the amount of Social Security benefits that are taxable varies. For instance, if your other income is low enough, all of your Social Security benefits will be income tax free at the federal level. On the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal rate is. So Bill finds himself in the latter scenario. At his current income after the concert trip, for every dollar that he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he also must add an additional 85 cents of taxable Social Security benefits. And if you add that up, that's $1.85 taxable at his 22% tax rate for every $1 of additional IRA income he actually receives. So if you do the math on that, it comes out to a 40.7% real tax rate on the additional $1,000 of income. That's the so-called Social Security tax torpedo. It can impact single filers and married filers with fairly modest income during any stage of retirement. And it's one reason why planning for taxes in retirement is so important. Let's look at another example of Social Security, or another aspect, I should say, of Social Security and the taxation and how people approach retirement. Now, during the go-go year stage, some people retire altogether, but other people enter into a sort of a semi-retirement. And sometimes it's a continuation of a previous job with just working fewer hours. I'm seeing that as a much more common thing people are doing. And I actually like that, by the way. If you're working a full-time job that we let you go part-time for a couple of years, it's a great way to start practicing for retirement, because sometimes going to zero can get a little bit boring for some people, and also the lack of activity can be bad. So others use semi-retirement to explore an interest in a new field. So still others use semi-retirement to pursue non-paid, rewarding volunteer work. So working in retirement can impact your planning and taxes in a number of ways. Some good, some bad, and some downright ugly. Let's look at how working during these years can be a good thing. Chances are you have researched what your Social Security benefit might be at various ages, but you may not know that your Social Security benefit is calculated using your highest 35 years of inflation-adjusted earnings. Okay? So what that means is it's not about the exact dollar that you earned 30 years ago. It's about that amount of money that's increased on an inflation-adjusted basis. So Social Security Administration does do the calculations on that. Well, what if you started working late in life? Or what if you left work to raise children? You may not have 35 years of earnings history. Suppose you only have 28. The remaining 7 years count as big fat zeros when they calculate your benefits. But there's good news. Earnings at any age can help you increase your Social Security benefit. And thanks to how Social Security calculates benefits, replacing several years of 0 years with even modest earnings can positively impact your benefits. Now, let's look at how working during your go-go years can be somewhat bad if you're already collecting benefits and unaware of the Social Security earnings limit that applies prior to you reaching full retirement age. Okay? So here's how the rule works. If you start Social Security, be it at your own retirement benefit or your spousal benefits, prior to the year you reach full retirement age, for every $2 you earn above a certain amount, that's $21,240 in 2023, Social Security will withhold $1 of benefits for every $2 you earn over that amount. Keep in mind that we're talking about earnings here. So this is W-2 salary or self-employment income. This is not pensions, interest, dividends, and capital gains. These do not count and won't reduce early Social Security benefits. For instance, let's say that you earn $23,240 in 2023. That's $2,000 over the limit. Therefore, under the $1 withheld for every $2 rule, Social Security will withhold $1,000 of your 2023 benefits. But the good news is these benefits are not truly lost. When you turn full retirement age, your benefit will be adjusted to make it as if you had applied for at full retirement age with respect to those withheld benefits. In other words, your benefit going forward will be a little bit higher. Also, in a year you reach full retirement age, there's a separate higher earnings limit. So we've talked about the good and the bad, so now you get the ugly. We're here today to talk about taxes and retirement, but the other taxes, there are other taxes you may face as well. For instance, while you're working, when you are subject to the 7.65% Social Security and Medicare taxes, in addition to income tax. The self-employed pay twice that amount, so that's 15.3%, and that covers the employer's contribution as well. Now, these taxes don't go away if you're working past your full retirement age or even if you're collecting Social Security. Worse, if your go-go earnings don't make it into your top 35 years, those Social Security taxes just go into the trust fund and they don't increase your benefit, right? So that's money that's just lost. And that's something you may or may not have known about. But it's one of those things where it comes to claiming your Social Security benefit and continuing to work, you really got to think about all the different aspects. It's not only about just getting the money because you might die next year. There are other things to consider there as well. So let's talk a little bit about Medicare and taxes. All right, so now let's talk about how Medicare and something Medicare calls IRMAA can impact some couples in the go-go years and beyond. So first, what is IRMAA? It stands for Income-Related Monthly Adjustment Amount. The emphasis is on income because it is a monthly tiered surcharge. Again, it's another tax in my opinion. So this is tacked on to people's Medicare Parts B and D premiums, but it only happens if you have an income over $97,000 for singles and $194,000 for married couples. So let's take a look at what that means in action. Meet George and Martha. They are a high-earning married couple. Both are Medicare Part B and Part D participants. IRMAA surcharges affect income from 2 years prior, and this couple was on track for $306,000 of modified adjusted gross income, or MAGI, in 2021. But on December 1st, 2021, George decided to sell a stock he bought for $10,000. He bought the stock on July 1st, 2007, and then he sold the stock for $11,000. The resulting $1,000 of gain was taxed at the 15% long-term capital gains rate, plus an additional 3.8% net investment income tax, which is something that comes in if you make above $250,000 for couples, for a total federal tax bill of 18.8%. That 3.8 net investment income tax, that comes into play when you are $200,000 or more in MAGI for singles and $250,000 for married couples. So George and Martha owe $188 of tax on the gain from the sale of their stock, right? 18.8% tax on $1,000. Or do they? Remember, my definition of tax is any cost it increases as your income increases. So then, George and Martha will owe more tax than $188 because the gain from the sale of the stock pushed them off the Medicare IRMA cliff into paying higher Medicare premiums. So let's take a look at that. So let's take a look at this Part B IRMA chart. That extra $1,000 pushed their AGI into the next premium tier that starts with $306,001. So now, instead of owing $329.70 each for their monthly Medicare Part B premiums, George and Martha will owe $428.60 per month, an extra $98.90 per month times 2, which is $197.80, for an annual total in additional income-related monthly adjustment of Medicare Part B premiums of $2,373.60, because remember, that's a monthly premium increase. But it's not over, because Medicare Part D IRMA charges are also impacted. George and Martha will each owe about another $19 per month for their drug plans, an extra $460 for the couple over the course of a year. Adding all the IRMA surcharges together for the year, George and Martha will each owe about $118 per month, or about $2,834.40 for the year. Now, combine that amount with the $188 of actual federal income tax they would have owed on their stock sale, and the total tax owed on the $1,000 of gain comes to $3,022.40. That's a tax rate of 302%. So let's do a quick review here. They sold the stock for a $1,000 income gain. The stock sale tax was $188. So that's a 15% long-term capital gain, 3.8% for the net investment income tax for high earners, for an 18% rate. The total IRMA surcharge for that amount, or for the year, was $2,834.40 for George and Martha. So the extra $1,000 in extra income triggers taxes of $3,022.40, which is a 302% real tax rate. You see, being pushed into higher Medicare Part B and Part D premium range is worse than being pushed into a higher tax bracket. That's because if you go over the regular tax bracket by even a single dollar, just $1, only those tax dollars are taxed at the highest rate. So if you go from the 22% bracket to the 24% bracket by $1, only that $1 is taxed at your highest tax rate. But if you go over the Medicare Part B and D income levels by even a single dollar, you move into the next premium tier. It doesn't matter if you exceed that limit by $1 or $10,000. That's what they call the IRMA cliff. So keep in mind, your IRMA payments aren't determined by how much money you made the previous year, but rather your MAGI from 2 years ago. It's another tax thing that catches people by surprise and needs planning. All right, so let's talk about example number 3 here. Making sure you enroll in Medicare at the right time is a critical decision. If you mess this up, you will get hit with a lifelong penalty. So to help you understand, meet Jim and Ann. Both 68. Jim retired at 60, Ann retired at 66. Prior to retirement, the couple had health insurance through Ann's employer, and they continued that after Ann retired because her employer offered retiree health benefits. Unfortunately, they didn't know that they had to enroll in Medicare Part B as soon as Ann retired. Even though Ann's employer offers free retiree health insurance benefits, those benefits are generally paid secondary to Medicare after retirement. But Jim and Ann didn't realize the mistake until it was too late. And thanks to the way Medicare enrollment periods work, they weren't able to begin coverage until the next year. So in a worst case scenario, this might have resulted in a gap in coverage for Jim and Ann if they had a major medical need. But even in a best case scenario, because Jim and Ann missed their deadline to sign up for Medicare Part B, they will each owe a 10% Medicare Part B base premium penalty for life. So you can see how much that translates into real dollars. So they owe $395 extra in 2023, and historically we can estimate that premiums will be higher, so that 10% penalty will grow and grow. Over the course of a lifetime, that can translate into a $10,000 mistake for the couple. For simplicity's sake, we're assuming that Ann's retiree health insurance benefits covers prescription drugs, so they don't have to sign up for Part D. Just know that there's a penalty for that as well. All right, so what are the other tax traps that we will face in retirement? We've seen how Social Security and Medicare have their own tax traps and unique rules and penalties. So if you're like some who've seen this presentation, you may be asking yourself, well, wow, what are the other tax traps we will face in retirement? Well, the rest of what we'll cover isn't like what we've seen with the Social Security tax torpedo or the IRMA Medicare cliff. The public generally isn't aware of those tax squeezes. What we're going to see now is how the tax code in plain view snags retirees, especially when there's no planning. And that brings us to our third key. You must plan how and when you will use your taxable, tax-deferred, and tax-free assets to manage your income and tax brackets efficiently. You can't be haphazard about just tapping your tax-deferred savings. Really timing is everything. And if you don't plan carefully through all the stages of retirement, you'll encounter some unintended tax consequences. And trust me, I've seen this day to day in the work that I do. It can be very expensive if you get this wrong. So let's take a look by first addressing a question I hear often when doing retirement tax planning. Which accounts to spend first? So here's a common example. Sam and Mary. They've been good savers, as you can see, and they're looking forward to spending their retirement years traveling and seeing their grandchildren. In addition to Social Security benefits, they have $450,000 each in an IRA, $60,000 each in a Roth IRA, and $300,000 in a joint bank account. And they want to spend about $8,500 a month or just over $100,000 per year. Where would you take that money from first? Most people think first take the after-tax money in the bank, then takes the tax-deferred IRA money, and then take the tax-free Roth IRA money. And this is the conventional wisdom. This has been promoted by many big investment firms for quite a while, quite some time. It's not a bad plan, but we know that conventional wisdom isn't always the best approach. Not surprisingly, this topic has drawn the attention of academic researchers specializing in financial planning. They've conducted multiple studies on how to prepare for retirement using a combination of Social Security, taxable bank accounts, tax-deferred accounts like IRAs and pensions, and tax-exempt Roth IRA accounts. You can see some study titles here. So their research has shown that the conventional wisdom approach probably isn't the most ideal. So here, in an alternative approach, there are two key elements in the early years. First, use the taxable bank money for expenses, but also during the same period, accelerate IRA distributions during the otherwise low-income years, putting that money into Roth accounts. This is the filling your tax bracket approach, which we'll discuss in a second. The alternative approach gives you more flexibility to use that tax-free money strategically in future years. Does it make a big difference? I think so. In the academic studies, this approach has been shown to increase portfolio longevity, which is how long your portfolio assets will last, without requiring you to take on additional risk, and that's really important. The big takeaway here, of course, is that you've got to plan all the way through retirement, especially around how you handle your tax-deferred assets, and that would be your pre-tax 401ks and traditional IRAs. And of course, see your tax professional for tax advice, but if you have a financial advisor that can help you with tax planning, it's really good to integrate your whole picture, because I can tell you this from personal experience. I've never met a CPA that really does future forward tax planning. Most CPAs are trained on planning for this year and last year. And when you have a financial advisor that can help you look at tax planning looking forward, you can really integrate both sets of professional advice to create the best plan that works for you. All right, so one way to help manage your income both before and during retirement is to utilize Roth IRA conversions. We talk about Roth IRA conversions around here a lot. And a Roth IRA conversion is a simple process that allows you to move money from an IRA or other pre-tax retirement account like a 401k to a Roth IRA. In general, the amount you convert is added to your income for the year and will be taxed at your rate. For example, if Jill converts $100,000 from her IRA to a Roth IRA, she will have to add $100,000 to her income. The conversion income will be taxed at Jill's rate. For that reason, it's recommended that prior to making any conversion, you consult with a tax professional or a financial advisor to help you plan your taxes. A conversion doesn't need to be all or nothing though. One helpful conversion approach is called filling up the tax bracket. And this is something we look at for all of our clients each year. Often you may find yourself in the middle of one of the tax brackets with room to add more income without pushing yourself to a higher tax bracket. For example, in 2023, the 22% tax bracket for married couples filing a joint return goes from about $89,451 to about $190,750. If you file a joint return and your taxable income is $100,000, that means you can add another $90,000 of income without going into the next bracket. Making a Roth IRA conversion like that could make sense. So if you plan to convert a large IRA, this approach is often more tax efficient than converting the full amount in 1 year. Instead, you can make smaller Roth IRA conversions over a number of years, filling up your bracket each time. This can help reduce the average tax rate you'll pay on your converted money and also spreads the tax bill out over a longer period. And this is the way I generally recommend. You generally do not want to convert your whole IRA or 401k in 1 year. Generally not the best idea. Roth IRA conversions can be especially powerful in years when your taxable income is low, such as having high non-recurring medical expense deduction or a low sales year for a business owner. It's also common for people who retire early and are not yet receiving Social Security benefits, pensions, or IRA distributions. They may have a very low tax bracket, making it a good time to complete a Roth IRA conversion in these pre-RMD gap years. This can also be another great reason to look at delaying your Social Security if you want to do a larger Roth IRA conversion and not fill up the lower tax bracket. So this is a good time to spell out the crux of things. You must know whether you're trying to keep your income below a bracket threshold to avoid bumping up to the next highest bracket, or whether you're trying to increase income to fill up a bracket to take advantage of that rate. Some tactics you could use in managing income around tax brackets might include withdrawing tax-free money from your life insurance policies to keep income low, selling highly appreciated stock for low or no capital gain, taking distributions from IRAs or 401ks to take advantage of a lower tax rate. As we have seen, you can also convert or consider a partial Roth conversion to fill up the lower tax brackets. These are all things where you can claim the income back without paying taxes, and these early retirement years are the most beneficial. And prior to taking Social Security is another time where it can be really beneficial for a lot of people. There are also 2 other pre-retirement strategies to consider, but they don't apply to all people. The first has to do with how you use a health savings account. So this would only apply to people who are covered by a high deductible health plan. The second has to do with small business owners. Those who want to be extra tax savvy and saving for retirement can fund a company pension plan, which for certain high earning business owners can increase their ability to claim what's called the qualified business income, also known as QBI deduction. Both of these features of the tax code could be used to manage your tax exposure and provide significant tax favor benefits throughout retirement. All right, so example number 6 here, charitable giving and tax planning. The critical importance of managing our tax deferred accounts, because at some point you'll be forced to take the money out during that required minimum distribution phase, also known as RMDs, and that can be very troubling to your tax bill. But many people make charitable donations, supporting their favorite nonprofit with annual gifts. So let's look at how your RMDs and charitable giving may work for you with some tax planning. Meet Albert and Shirley, who are in the 24% tax bracket. Now, the standard deduction for married couples filing joint return in 2023 is $27,700. But Albert and Shirley are over 65, so they get an additional standard deduction, bringing their total standard deduction for 2023 to roughly $30,700. This means they will receive no tax benefit for any itemized deduction unless their total exceeds that $30,700 mark. So over 90% of people now don't receive any sort of itemized deductions anymore. So this could be a really good strategy for you if that's you. So they get no federal income tax benefit from making the charitable contribution because it doesn't exceed the $30,700 tax standard deduction. That's not to say they shouldn't do it, but they should understand it's not helping them to save on taxes. If you're over 70 and have an IRA or inherited IRA, there is another way to give to charity than simply writing a check. It's called a qualified charitable distribution, or QCD for short. Let me explain how this works so you can see why a QCD can be so powerful. First, some rules. If you are 70 and a half or older, you can make a qualified charitable contribution of up to $100,000 each year from your IRA. If you're married and both of you are 70 and a half or older, and both of you have an IRA, you can each make up to $100,000 qualified charitable contribution from your own IRA. Second, any qualified charitable distributions you make counts towards satisfying your required minimum distribution for the year. So this can be a really good way to, 1, avoid the RMD, 2, give to charity, and 3, really impact your tax bill. So third, and this is the odd part, even though you gave to charity, you get no income tax deduction. So why would I suggest a strategy where you get no deduction for giving to charity? Because when you make a qualified charitable distribution, the distribution from your IRA is never counted as income when you compute your taxes. So let's see how that helps Albert and Shirley. First, all right, let's suppose Albert and Shirley do what many retirees do, and Albert takes his RMD of $5,000 at the beginning of the year and deposits it into the bank. he's done with his RMD for the year. Now, being charitable people, they donate $5,000 to charity. The end result is that the charity gets $5,000. Everybody understands that, right? Now, let's look at it more closely. By virtue of giving to charity this way, Albert and Shirley's $5,000 charitable contribution will cost them a total of $6,200. Why? Because the $5,000 RMD that went into Albert's checking account at the beginning of the year still has a tax cost. Remember, the couple is in the 24% tax bracket, and 24% times $5,000 equals $1,200. So the $1,200 of additional tax that Albert and Shirley must pay when they file their taxes means the total cost of the charitable gift is $5,000 plus $1,200 or $6,200. Remember, the gift didn't impact their standard deduction. The RMD behind the gift just added to their income. That hurts a little bit. Now, let's see what happens if Albert and Shirley use the QCD to give to charity. Instead of requesting a $5,000 distribution from his IRA to go into his bank account, Albert simply would have his IRA custodian transfer the money, the $5,000 RMD, directly from his IRA to the charity, and this satisfies Albert's yearly RMD because he's over age 73. Now, the charity is in the same position as before. They'll still receive the $5,000 donation. That's a good day. Albert and Shirley, however, are in a better position. They still give $5,000 to charity. Even though they receive no deduction for making a contribution, their IRA distribution is excluded from their tax return. Therefore, they owe no income tax on the $5,000 distribution. Their total cost to give the $5,000 to charity is $5,000, a $1,200 savings over our previous example, simply by knowing how to use the tax rules to their advantage. And they did it all without ever getting a deduction. But we all know that charity starts at home, so it's a natural question to ask. How does retirement tax planning figure in? It's a very good question because the government still wants its share of those tax-deferred assets when you pass away. And like we've seen, how you set things up really matters, which leads us to our final key, number 4. Organize your assets for your family's benefit. Estate planning still matters. Right? Estate planning is always a relevant topic, even though people don't like to discuss death. But we're not going to discuss it in the traditional way. That's because a new tax law excludes estates valued at up to $12.92 million from federal tax, meaning only the tiniest fraction of people need to worry about estate taxes. No, you may still face an estate or inheritance tax at the state level. Still, very important tax issues remain around how your assets are received and how your beneficiaries will receive the assets after you die. One example is making sure married couples plan for their available step-up in basis. That's quite a tax term, right? Simply put, a step-up in basis is a tax rule that readjusts the value of an inherited asset so its value is not what your spouse or decedent paid for it initially. Instead, it's the stepped up to its price at the date of death. This can make a big difference, as we'll see. So it's likely that most assets you own other than your retirement accounts and annuities will be eligible for a step-up in basis. Let's consider Phil and Mary, who live in a separate property state. They're married and own a variety of taxable investments in a joint account known as joint tenants with rights of survivorship, also known as JT Ross. And the investments have long-term capital gains of $120,000. One day, bad news arrives. Phil is diagnosed with terminal cancer. He has 18 months to live. Let's see how this works with two scenarios. In the first, Phil and Mary make no planning changes to their assets. When Phil dies, Mary will receive a step-up in basis on Phil's half of the joint account, which is $60,000. She'll still face a future $60,000 of unrealized gain on her half of the account. Simply put, that means if Mary decides to sell the assets, she'll owe tax on her $60,000 of gain. Now suppose that upon Phil's diagnosis, Mary and Phil moved all the assets into one account in Phil's name. Then, as long as Phil lived longer than 1 year, Mary would receive a full step-up in basis on the entire $120,000 account. Simply put, Mary could sell that account and pay no tax. This is, there's so many ways to really optimize for tax planning that if you're trying to do this on your own, I really think you could be missing out. But when you go to sell your investments, would you rather owe tax on $60,000 of gain or none? So let me say, planning around death is hard. Nobody wants to deal with this. Nobody wants to talk about it, but it is a part of reality. And this is where a professional can help because there are emotionally removed from the situation and can assist you in making good decisions that may seem hard at that time. I think it's very difficult to sit down with your spouse and have these conversations, but having a third party with a trusted advisor can make it a lot easier, in my opinion. Maybe you're someone who has managed to save quite a bit in your IRA or 401k. You feel pretty confident that you'll be comfortable in retirement and are hopeful that you'll leave behind the account to your children. In the past, we've recommended that because with the right structure, your heir could withdraw the money throughout their lifetime, possibly decades. But that's changed with the passage of the Secure Act, which passed in December 2019. Now, beneficiaries of inherited accounts, with some exceptions, must withdraw all of the money within 10 years of the owner's death and pay taxes on that money. This restriction on what was called stretch IRAs shines a light on how important it is to have tax planning for these accounts. Laws can change at any time, so you need to have a plan and revisit this plan regularly. I can tell you, since 2017, there have been 5 major tax legislation changes that have impacted retirees. Okay, and it just keeps coming, by the way. So let's look at Pamela and Kyle as an example of what choices beneficiaries have when they inherit IRAs and can no longer stretch distributions over their lifetime. The first scenario we have is Pamela and her son Kyle. Pamela unfortunately passes away, leaving her full IRA to her son Kyle. He is an only child and the sole beneficiary of the IRA. We know Kyle has a maximum of 10 years to withdraw the IRA monies to meet required minimum distribution rules. Kyle likes regular distributions, so he chooses to take an equal distribution of the funds over 10 years. The IRA earns an average of 6% return annually. This payment would calculate to be $54,347 to Kyle each year for 10 years. Kyle would have to add this amount as income on his tax return for 10 years. The second scenario for Kyle looks a little different. Kyle lost track of time, and he's already reached year 10 of the required minimum distribution window. Since it is year 10, he must now take the full distribution in 1 year. Assuming the same 6% rate of return is earned annually on the $400,000 IRA, we can calculate that the IRA balance has grown to $716,339. Kyle must take the full $716,339 as a distribution in year 10 and pay income tax on that amount. So in that year, Kyle is likely to be in the top tax bracket in year 10. And in that case, he would lose a huge chunk of that IRA that you passed on to him. So that's something, again, you really want to think about your planning if you plan to leave money behind, and you might have a little bit more left over than you expect. Okay, so enough about death. Let's talk about long-term care. This is not a long-term care presentation. It's about retirement and taxes. But believe it or not, there are a number of tax breaks associated with long-term care insurance. For example, long-term care premiums may be deductible medical expenses at the federal and possibly eligible for deductions or credits at the state level. And on the other side, if you're receiving long-term care benefits, in many cases, those benefits are tax-free. For instance, benefits received from reimbursement-style policies are tax-free. In addition, cash benefit-style policies are tax-free if they don't exceed the higher of your actual long-term care costs or an IRS daily limit, currently $390. Choosing how you pay for long-term care costs can have a big impact on your estate and your heirs. In recent years, non-traditional long-term care policies that blend together some long-term care insurance and life insurance have become popular. Often the first inclination of the insured is to tap the policy to pay for long-term care costs, but that's often a tax mistake. Let's take a look at Florence. Florence is a widowed woman who qualifies for long-term care benefits and lives at home with in-home care. Her yearly long-term care costs are $60,000. Florence's Social Security benefit is $20,000 annually, which covers her basic expenses but not her long-term care. She also has $400,000 in an IRA and a life insurance policy with a long-term care rider, which will pay $500,000 to Florence's children upon her death. Alternatively, Florence could use up to $10,000 per month for long-term care costs. Any amounts used for long-term care will reduce the life insurance death benefit. Please note, this is just an example and it's not meant to represent any specific policy, but many long-term / life insurance hybrid policies work this way. First, suppose Florence is infirmed for 5 years and uses her policy to pay for long-term care expenses. That's why she bought it, right? Here, Florence pays little to no income tax during this period because she'll have such large unreimbursed medical expense deductions. The $500,000 policy pays out $300,000, $60,000 per year for 5 years. That means her kids will inherit tax-free life insurance of $200,000, the remainder of the $500,000 policy value. In addition, her children will receive $400,000 in her IRA, which will be taxable to them. Now, let's suppose Florence lives for the same 5 years, but uses her IRA money to pay for long-term care expenses instead. Florence still pays minimal income tax per year because of her high medical expense deduction. Now, the kids will inherit the $500,000 life insurance policy completely tax-free, as well as roughly $100,000 of remaining IRA money, which will be taxable. Comparing to some scenarios, the ultimate net benefit is unknown because it depends on Florence's children's tax rates, but it's hard to imagine a scenario where paying for her health care with $300,000 of taxable money with minimal cost to Florence is not a better option than paying for her care with $300,000 of tax-free money. In the second scenario, we're preserving the tax-free money for the heirs and paying for the long-term care with Florence's taxable IRA money. Goodness, how in the world will we ever manage this? It's a good question. So let's bring it all together. We started with a clear statement about the problem. Retirees often pay more taxes than expected because a confusing system treats various types of income differently and contains hidden taxes and penalties. So let's do a quick review on what we learned in the context of the 4 stages of retirement. Under the pre-retirement heading, we saw the importance of understanding the after-tax value of your retirement savings before you retire. Also, we saw that in those pre-retirement years, it's critical to consider your tax-deferred savings and taking advantage of funding Roth accounts to fill your tax brackets. Something you'd do through your early retirement years and in low tax years. We also looked at Social Security and taxes, plus the importance of couples have benefits strategy that considers a surviving spouse. And we also saw Medicare has its own tax-like structure that can push you off the IRMA cliff. And we saw the importance of signing up for Medicare on time, right in the middle of those early go-go years. That's because starting in your middle retirement years, you'll be confronted with required minimum distributions, and we've seen the importance of planning your income needs before then and the tax issues involved. And then we saw the importance of setting up your assets and managing them during the later years of retirement so that you can preserve the most for your heirs and leave them with the most tax flexibility. All those items together led us to this obvious solution to our original problem. Because your tax exposure will change through retirement, we need a strategy that, 1, anticipates how and when you'll tap your assets to cover your personal expenses, understands the range of taxes you will face at various stages, manages your actions so you pay the lowest tax rate possible. So by attending this presentation, you're indicating that you're preparing to leave the accumulation phase, which is saving for retirement, and moving to the distribution phase when you start spending retirement assets. We've seen that the distribution phase is more complicated than working and collecting a paycheck. Managing your tax rate through the 4 stages of retirement is part of the challenge of retirement planning. We've seen the cost of mistakes. Naturally, we want to be efficient with our savings, and there are strategies to reduce your tax burden. But with many things in life, this takes education and planning and advice. It is a lot to think about. Our tax code is complex, and the rules keep changing. But what doesn't change is that you need a plan. So again, there's a lot of information here. I really hope you found it beneficial, but if you want to take the next step, I am going to offer you a way to help you get started with creating a retirement tax planning strategy. So if you would like to request a taxes and retirement planning overview meeting, this is a complimentary 1-hour service that I offer. My normal rate is at least $300 an hour. And if you go to the site, we can schedule a complimentary one-on-one meeting where we can talk about your retirement and savings needs and the role taxes play. We're going to do a deep dive into your tax planning strategy for retirement, and it's going to be 100% free. During that meeting, we identify where you are and your family stand in regard to preparing for retirement. We'll review your timeline and identify the key retirement planning and tax issues that you need to anticipate. Coming out of that meeting, I'm happy to act as a resource for you to help you find the right people to assist you with specific tax advice, or naturally, we can help you if you want help with your tax planning and your key financial planning and investment advice that relates to your situation. Regardless, when you leave the meeting, you're going to be better informed about your retirement planning needs and what to consider doing next. And my main thing is that I want you to be prepared and organized for this aspect of your life. I created this Facebook group so that you can get information, you can ask questions, and you can get all the education, or ideally most of the education that you need to have a good retirement planning situation, so that you and your family can have peace of mind knowing that you've got a plan for making the most out of your retirement accounts. So if you're interested, I will put this site in the comments to this presentation, to this workshop, so that you can click on it, or you can just go here and schedule a call if you'd like to do that. So I will also be giving you a copy of an excellent resource called the Guide to Taxes in Your Retirement, and I'll send that to you after our call by mail. So other than that, I really appreciate you watching. I have a lot more education coming. So I really appreciate everything, everybody here showing up for this workshop today. So if you have friends or family members that are getting close to retirement, or even if they're not, by the way, invite them to this group. Let's bring everybody in so they can get more education, because you see, I answer questions in here all the time, and not all the questions are directly about retirement specifically. So I am happy to address questions for people that are further away from retirement. But other than that, I just want to do my best to make sure you're educated, you're confident, and all of your finances are in the best possible position for you and yourself in your life, even if you don't reach out for our help. But if you do need help, we're here for you. You have a resource. We're fee only, we're fiduciary. You can find us at keepitsimplefinancial.com. And other than that, folks, enjoy the rest of your day, and we'll see you next time, okay? Have a great day. Bye now.